Don't worry, little buddy. You're gonna be my next Bitcoin. We don't need anyone. You're going to the moon. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just signal. That's why you're losing money. Let's talk about not being a one-hit wonder. They say there's not such a thing as a free lunch in economics. Everything has a cost, a trade-off, or a hidden fee. But Harry Markowitz, a Nobel Prize winner, disagreed. He called it diversification, the only free lunch in finance. Today we aren't just talking about buying different stocks, we're diving into the mathematics of survival. Before we start, I want to see where this community stands. Are you a concentrator all in one, or are you a diversifier, the influx fund army? Drop a comment below, team focus or team wild. I'll be reading. Concentration versus diversification. Concentration makes you rich. Diversification keeps you rich. That is the old Wall Street saying. If you put all your money into Amazon in 1997, you're a genius. If you put it into pet.com, you're broke. Most retail investors confuse luck with the skill. When you concentrate, you're betting that your information is better than the million of algorithms on Wall Street. Diversification isn't about admitting you're wrong, it's about admitting you can't predict the future. By spreading assets, you reduce the impact of one bad decision without necessarily sacrificing long-term returns. Correlation, the fake diversification. This is where most people fail. You think you're diversified because you own Apple, Microsoft, Nvidia, and Google. You don't have a diversified portfolio, you have a tech bet. In finance, we look at correlation. If two assets have a correlation of 1.0, they move like twins. If they are minus 1.0, they move like enemies. To get the free lunch, you need assets that don't talk to each other. When stock go down, maybe gold goes up. When the dollar weakens, maybe commodities roar. If this clarifying your strategy, hit that like button. It tells the algorithm that financial literacy matters. Idiosyncratic risk, the silent killer. There are two types of risks. Synthetic risk, the big one. A global recession, no one escaped it. Idiosyncratic risk. This is specific to a company, a CEO scandal, a factory fire, a failing product. If you own one stock, you're 100% exposed to idiosyncratic risk. If you own 30 stocks across different sectors, the risk virtually disappears. You are left only with the market nation grow. Why would you take a risk you aren't being paid for? Portfolio construction, the TradingBits X way. So how do we build it? Step 1, you define your horizon. Step 2, select non-correlated assets. Step 3, rebalance. Diversification is only a dynamic process. It requires the discipline to sell what is performing well, to buy what is undervalued. It feels counterintuitive, but it's how wealth is sustained over decades. But here's the truth, even the most diversified portfolio in the world will fall if you don't only know how to manage the down days. Diversification protects your math, but risk management protects your mind. If you don't have a plan for when the market drops 20%, your diversification won't save you from a panic sell. If you want to master the art of the long game, make sure you're subscribed to TradingBits X. Share this video with one friend who still is all in on a single penny stock. You might save their retirement. Speaking of survival, you need to watch our next episode. We'll be breaking down drawdowns, position sizes, and the psychology warfare of volatility. Click at the end of the video to watch the full story. And remember, money, markets, we're trading the future. See you in the next one.